Welcome, friends, to another episode of Kuvera Insights, where we talk to industry leading experts on how to better prepare for your financial future. Once again, two very interesting guests that we have with us. Swarup, he's the CEO of Mirae Global Investments, has over 24 years of experience in financial services. Prior to Mirae, Swarup was national sales head with Belliger, Aditya Birla, and Franklin Templeton. So a lot of mutual fund history there. We also have Niraj Shah, who is a very visible face. Everyone knows him. He's from Bloomberg Quint, the host of very popular Alpha Moguls and the Mutual Fund Weekly Show. Niraj has a master's in finance and a master's in commerce degrees, and he's the founder of Anzizi. Am I pronouncing it correctly?
Yeah, it's Anzizi.
Anzizi, a non-profit charity for cancer cure. That's pretty fantastic, Niraj. So, welcome, gentlemen, and thanks for taking some time off for us. Let's start with, what's the most popular topic these days. Just over to you, Niraj, quickly. What's the industry reaction to the 20 lakh crore package?
Well, on record, off record is the question, but no, really.
On record.
No. I mean, when you really talk to people, select sectors have been pretty enthused by what has happened. I think a lot of people are believing that once the lockdown ends is when some of the other measures would be announced as well. I think there's a column written today on bloombergquint.com as well by Mirae Sharma. And this fair degree of argument that when the lockdown is in place, why would the government use a lot of money right now, and maybe some crunches will come in later on. But I mean, as all of us know, the fiscal number is not 20 lakh crores any which ways. So hoping for some more announcements.
And so coming to you now, Swarup, right? As a mutual fund, right? I mean, someone asked me this question as well, so I might better ask the experts, right? From a mutual fund perspective, right? How does it affect? How does it affect you? How does it affect the AMCs? How does it affect a mutual fund investor? Was there anything in the package that should make them happy?
Actually, when you look at the package, I sort of echo Niraj and take it forward. It was more a reform package than a stimulus package. I mean, there are two sides to the whole thing. People who wanted some cash in their hands probably would be disappointed. But when you look at the road ahead, yes, what they're making, what they put on the table is not something which is irrational or illogical. Whether it addressed the present issue is something which we need to discuss. But from a mutual fund perspective, our job is always very simple, and our job is not to sort of predict anything, look at the atmosphere and have the capability of putting 50, 60 good stocks in the portfolio, looking at the present environment. And that's something which we will continue doing and not complicate ourselves. There are opportunities within this space, and if one is a little rational and plays it out. I mean, let's face it, I mean, in December, some of the large companies were available at prices which we were not buying. And then today, those large companies are probably available at prices which are pretty attractive. And hence, this margin of safety or the risk of investment in equity being lower now, right? And hence, one should continue the SIPs, one should remain invested and all that. This also signals the interest rates going softer, and then those also give you opportunities. And if one looks at it from that perspective and is constructive on the portfolio, there are opportunities at this moment.
So how
Gaurav, can I ask you? Gaurav,
sure,
Gaurav, sorry, can I ask you, sitting from your perch, what have you made of it? What do your set of investors or the global investors talk about it?
So, interesting question. See, on our platform, through March and April, the flows have been pretty steady. We actually have seen a lot of buying happening on down days. Surprisingly, and we have been very vocal about it on all social media also, at least for our platform, at least from the limited data set that we are seeing. Some of it is also being echoed in the larger mutual fund SIP numbers. If you see the monthly mutual fund SIP numbers, they are holding very steady. We are, in addition, I would say, we are seeing a lot of lump sum coming in down days. Going back to the point, are people very enthusiastic about this package? I mean, the headline number sounds phenomenal, 10% of the GDP, nothing there, not to dislike it. But when you start cutting down to it, it's more a liability and a reform package than an actual handout. And that's why I think the market also reacted the way it is. So that's what we also hear. Coming back to to sort of just one follow-up question in terms of inflows, right? So I just mentioned what we are seeing on the platform in terms of inflows. How are you guys seeing it, and is the opportunity more for a fund manager to rebalance, or is it a new money coming in that is being deployed in these opportunities?
See, as a fund house, we are a fully invested fund house as a policy. We don't take
Right.
cash calls. So we believe the best time to invest is when you have the money, right? And luckily for the last 5-6 years, we've been net sales positive on a monthly basis on a trot. So that continues. Please understand at this moment, we are not exactly a fully open environment. It is just the online transactions which are being accepted, and that comes with a certain constraint on the
Right.
overall inflows. So our inflows have dipped a bit, but they continue to be fairly positive. As you rightly pointed out, the SIP book has held on very strong. In fact, we've
Very
got
strongly,
additions
yeah.
there. And that's the change. And yes, I do agree that there is a definite buy on dips. There is no denying the fact, and Niraj will sort of echo with me on this one, that there is money in the market, and the change in the investor and more important, the advisory behavior in this environment is phenomenal. I mean, people are looking at more opportunities than anybody is scared or anything, and that just speaks of the advisory environment being more mature over this period, and we are seeing that on our platform. Luckily, on the debt side also, our portfolios have held steady, and that's beginning to play out. Some of our funds, which are now building track record in excess of 3 years, are beginning to see some traction in the market. So we are seeing inflows on both sides.
Carrying on that point, actually, Raj, what do you think about the credit space? You think there's some more pain there? What are you hearing?
I mean, it's interesting. I think the transfer of the illiquid funds has kind of set the cat amongst the pigeons as well, and views are differing on both sides out there as to whether that is an event to monitor. But I think it's been hit by not an avalanche really, but a slew of small speed breakers over the last 2 years. I think the view is quite divided out there, Gaurav. The general view seems to be, as I think both you and Swarup will agree, that rates are on the way lower, and therefore you got to brace yourself for that. But hey, you never know if inflation rises around the world, and in India, if it does come back, then it's a different piece altogether. But yeah, there are some accidents out there that have happened, Gaurav, which I'm sure you would be having a lot of opinion as well as inquiries as well, right? Because maybe Swarup's funds haven't been impacted, but a bunch of others have been in the news for a lot more than one reason.
It's also it's also not just a question about what happened. Not a question about just default. A lot of times the question is what happened. A lot of the things that are happening now, where money is being transferred from one fund to the other, always used to happen, but was never in the limelight like it is now. So a lot of
that's
things
true.
are being raised. I mean, a lot of investors are realizing for the first time that this is also possible. That in effect, my fund, the fund that I have invested in, can become a bank for the rest of the AMC. It's literally that's what it's becoming, right? I mean, you can call it one way or the other, and that explaining itself takes a long time. So a lot of such questions are being asked. I think FT, of course, was a very big period of 2 weeks where everyone was literally questioning every and any credit fund. In a way, the one good thing in the 20 lakh crore package was that the NBFCs and the housing corporate, those bonds were backstopped. So that was
just a
one
couple of
sorry.
Yeah, no, sorry, just a very quick 1 minute answer from both of you, if you will. I'm a bit, because I've got different views out here. Should a BAF fund absolutely not have any kind of credit risk, or some bit of 5, 8, 10%, 12% is okay?
I'll give you my 30-second answer. I think a BAF fund can and should have credit risk as long as it is capped appropriately. The bigger question here is, should one of your fund bail out another fund? And that I'm not very. So should one of your fund act as a bank to one of the other funds? Because that creates a very bad precedent. The argument against that is it's a small amount, 40,000 crore ka fund, 1,000 crores doesn't make any difference. It's a matter of principle. It's a matter of setting a precedent, and that I think is a slippery slope which can be misused. But it's a balanced advantage fund. It can have any and all kinds of risks. So why not credit risk? My views completely. Okay.
Yeah, I don't know if Swarup wants to share views, because it does impact some of his peers. But Swarup, just very quickly, would you be comfortable taking some risk in your funds? I'm not asking you to comment on what's happening in the industry right now.
My views on BAF are very clear, and I don't believe a pool structure can be portrayed as a asset allocator for individual investors. It is fundamentally flawed. So it's a category in itself, and the way we run our hybrid fund, I could probably share views on that. On the hybrid side, we're very clear on the debt side that the debt side is capital preservation and the returns will come from the equity side. That's how we run it. We don't take much credit on the debt side, and whatever credit we take is probably bank and PSU and top quality AAA. We will not go below that on the debt side of a hybrid fund is our positioning. And even on the equity side of the hybrid, being the nature of the positioning of that product, the equity side is also large cap dominated.
Gaurav, you want to start off with importance of goal planning? I think you and Swarup want to talk about the glide path as well.
Sure. So one of the things, I think Swarup is also a very big proponent of goal planning. One of the things we very strongly believe in is that goals do help change. The basic idea is very simple. If there is no goal planning, then your only focus is on returns. And what goal does is it changes that framing to something about later life fulfillment of actual things you want. So simply put, if you're chasing returns and you want 15% returns and you see a 20% fall, you're suddenly supremely disappointed because that was the number you were tracking. But if you're investing for a retirement goal of say 1 CR and something like this happens, and then now you see, okay, 30 years down the line, my retirement number now looks more like 90 lakhs. You're like, okay, yeah, 90 lakhs is still not bad. It's still a fantastic retirement, right? Or whatever that number is for you. So changing that framing changes the context on how you live through a volatile time. Swarup, if you would love to add here something.
I completely agree with you, Gaurav, because there are just two types of investors. Either you are an investor with a goal, or you are not an investor. So that's how I look at it. Because when you start an investing process, the most powerful question is you ask yourself is that single word why. Right. If you don't attach a why to your investing, or you don't know where you are going, you will not find the path to going. Return-wise investing is a very transactional investing, and that's where you deviate from your entire path or the purpose of why you are investing. So hence the goal is the center of everything that you do. And look at it. Say look at COVID at this moment. There's a dramatic difference between an investor who has a goal and a person who has a return chaser. The person who had a goal knows exactly where he stands at this moment, knows exactly where he's deviated from his path. And with talking to people like you, can come back to where he wants, right? The process is very simple. It starts with a goal, and the underlying scheme is just a means to that goal, right? The star in this process is the goal. We are, as funds, are just the means to that goal, and that's how we should be looked at. I mean, if the goal is ascertained, for all you know, he need not invest at all. He or she might be having the money in the bank. So why get into this complicated structure? So that's where I am a big proponent of goal investing. And without goals, one should not invest.
Just to put some data behind this also, Niraj, I think people do want to plan for goals. I think given an opportunity, like on our platform, we see about 2.2 goals per investor. Wow. Right? And these are all, and we don't have lifestyle related goals. We don't have a goal which says in 3 months, I want to buy an iPhone. These are all these are all actually, those are also important goals, but we focus more on retirement and, kids' education and buying a house and buying a car. And I think people like the fact to figure out whether I'm investing enough. Can I retire when I'm 45 or 50? Whether they will retire or not is not the question here. It's just more about someone getting that idea that they'll be able to do this. And I mean, Niraj, do you personally believe in goals? Do you plan for goals? I mean, that would be a good thing to know.
No, I do. I mean, and mutual funds is one way in which this has helped. I mean, long ago, I stopped my, might be a bad thing to say, but I stopped my PPF and I reverted that amount also in funds. So I do believe that equities is the way to go. I'm primarily equity biased, but yeah, I do use that tool to plan for my goals. But just that, Gaurav, I also use some of this for near-term goals and not necessarily only retirement. But yeah, all of those form a part of my process.
But which makes sense, right? I mean, we had added a goal called, vacation, and a lot of people started adding 2 years vacation, 3 years vacation, and it's, I mean, not all goals have to have the seriousness or the weight of, education, marriage, and house, and Fun is
No, see,
important, right? Consumption is important.
yeah, I think Gaurav, you are hitting on a very important part because see, the goals are changing dramatically with generations.
Right.
They're changing from assets for my father and me to probably experiences for my son.
Fair
And
enough.
please understand that that part of the demography is the one which is going to invest going forward. So each one's goal is correct. There is nothing wrong or a defined sort of goal to anybody's life. It's the person's life. Hence, everybody's goal. If I were to put out my goals, you'll start laughing at me. How can this be an important goal for you? But it is for me, right? And so it's very important.
It's
But
it's
you
it's a
know,
personal
point.
choice thing. Yeah.
Yes, absolutely. And but when you look at a COVID sort of scenario, I think post COVID, I think the trigger that was needed for goal planning starts with COVID, is my opinion, because nothing happens till it does not happen to you. And clearly, some of the debates between wants and needs are addressed during COVID. Suddenly, we are very well functioning without our wants, and life is pretty cool. So the financial statements are set to change, and that's where is the opportunity to sort of restructure ourselves and get more steady on the financial planning side. Is an
Yeah.
opinion that I have.
Gaurav, Swarup, just one thing to add out here. I think what COVID-19 has probably taught us and will teach everybody is to also have some ammo for a goal, which is or a goal or a provision for risk. Right? You don't normally budget for the tail end of the risk, and when it hits you so hard, as Morgan Housel aptly put it in his post yesterday.
Correct.
And I think that will get people to thinking about providing for something which is unforeseen. We all provide for things which are visible and which we can imagine. What about the unimaginable? I think that's something that will come up now.
Neeraj, luckily for me, 2000 happened in my life very early in my investing career,
Fair.
right? And that's when I very quickly and I was ruthlessly reminded that this is a business of risk, not a business of return. And imbibed that in the portfolio, and then the 2009-10 sort of fiasco got me the benefits of holding on to allocation. So those two crises have helped me as an investor, and today I believe I am taking opportunity of this much better because of those two.
Gaurav, before
To
you
your
ask the
point,
next
Neeraj.
question, what did you do? I mean, because starting a business would have involved a lot of risk, right? Some
Right.
unforeseens, etc. Quick 30, 60 seconds, if you will.
Sure. Right. So there was about a couple of years of money in the bank, because early on, very small company. We were 10 of us. We're still a very small company. We are only 49 people compared to a lot of our peers. But the whole idea was that, okay, you know what, you have 2 years of self sustainability, and that's the time period in which you have to build something, because in those 2 years you're probably also not going to get a salary. Eventually you start getting a small salary, and hopefully if the product is well liked, the product grows, then you start getting attracting funding and things move forward. But that was very important for us, and in fact I'd written about this as well, that if you're looking to, if startup is something on your mind, then first thing you have to do is take care of cash flows, because especially when you're starting a business, there are so many other things you're going to be getting hit on. And if your personal finances are not in order, then that's an extra stress that might as well just wait for 9 more months, build that emergency fund, or build that kind of safety net. Because at the end of the day, right? I mean, how many battles can you fight? You're building a new business. There's 20,000 things that are supposed to be have done yesterday, but you're still doing them today. And then you
Correct.
have this whole thought here, how am I going to pay rent next month? So
Yes.
that's how I approached it. Thankfully, I've held pretty decent jobs in large multinationals, Capital One, Morgan Stanley. So I had some money in the bank to be able to take this risk. But that was very helpful, because I mean the first 2 years for us was quite hard, to be honest.
Yeah, sure.
But just one point before we move on, I think the realization that has happened due to COVID in my financial plan is that we used to follow a very straight line sort of financial plan, and here was this: you put a return part of it, you fix your goal, and then you put an inflation part, and you had 2 years goal. But an event like this probably derails you, and that's where I feel going forward we will graduate more from a straight line financial plan to a glide path financial plan, which de-risks your portfolio as you approach your goal. You put triggers and you move towards a safer asset in periodic triggers, and by the time you reach your sort of goal, you are more attuned to in a safer asset than you were in your earlier plan, where you were riding the same sort of asset allocation to. And that's something which will dawn into many of us, and we'll plan our goals in a far more safer manner, or the journey in a glide path rather than the straight plan, is an opinion which I feel, or a realization which I feel, which an emergency or a crisis like this sort of throws up. It's a great learning, I think, for me personally, and we are talking about it with a lot of people. I do believe you have. Gaurav, in your this thing, certain triggers which do put them up. If you could talk about it, I think it will benefit everybody.
The way we do goal planning, so our goal planning is fundamentally based on the glide path. Glide path, very simply put, is if you have a 10-year goal, you start with say an 80 equity, 20 debt allocation. But as your goal becomes closer to completion, you move to probably a 10 equity and a 90 debt allocation.
Absolutely.
The whole
Yes.
idea here is that if you can visualize it, that say in 2015 you had a 5-year goal, and you stick to your 80-20 allocation, and then something like 2020 happens, which you in the business called the pot risk, and the market suddenly falls, and you needed the money in March urgently. Suddenly equity is down 30%. You did everything right, and still the risk came to bite you. So the glide path just kind of smoothens that out by saying that, hey, you know what? It's okay. Your risk appetite is really high, but you need the money in 3 years. Might be a good idea to move to a safer instrument. So our goal planning takes into account a glide path, and we do recommend investors on how to kind of rebalance as they get closer to a goal. It becomes slightly complicated though, but it's okay. I think a lot of people do value it.
Fantastic. No, I think the emergency fund was a thought, and now post-COVID will be practiced.
Will be practiced, yeah. Yes, I think, and the good thing though is that the industry is prepared for that. Liquid funds, which can have instant redemption, they are probably the best way to do this, and they are already getting a lot of interest.
Yeah.
This thing comes up in every down market. Should you have a long only strategy, right? And I think Ray Dalio has recently written about it. So I'll keep it open, Niraj or Swarup. How do you guys think about this? How do you guys contextualize it? It comes in every drawdown, and then it goes away as soon as the market starts rallying. So when right now, a lot of investors would be hearing things like, "Are you hedged? Are you buying put options? Are you buying this?" Right? Like hedging becomes that word, as if like everyone knew that they had to hedge. If you knew you had to hedge, you would have just sold, right? But what do you think, Niraj? What do you think, Swarup?
Okay, so just a very limited view out here is that if you are expert enough to, I'm not even talking about whether you're expert enough to time the market. I think let's leave that most people can't do that. But even if you're not an expert to time the market, at times just looking at what the telltale signs around you are telling you, it might make sense to not try and time and completely get out of equities, let's say 12,400, because you are so good that you can time that. But it might make sense to take some chips off the table at times. As much as you are a mutual fund investor, over a period of 15-20 years, if you invest actively in mutual funds with the help of your advisor, like your platform, for example, you can probably try and gauge what the sentiments are not telling you. And maybe that might help. Long only is great, but maybe at times, some chips off the table, putting in some extra money when the markets are down, might actually give you better returns.
Fair enough.
No, I do agree. I think the portfolio rebalance is a very important part of your review process, and periodic review sort of gets you back on track. And then there is enough evidence, and we've done some great study on the hybrid category to bring it back, that the periodic review actually adds to an alpha also. I mean, let's look at COVID at this moment. Suppose my portfolio is a 60-40 and my 60% is down by 20%. I have to rebalance that 20% from the debt side, and post COVID I will replenish the 20% on the debt side. But again, on the underlying, if the underlying is along with my target return, then it's fine. But if some of them are going away from the target return for a periodic period, I have to sort of work on that. So the periodic review is a very important part of your plan process, and be very unemotional about that. Be as mathematical as possible, and one does it like that, then you're on track for your goal is sufficient. I do agree that long only strategy may or may not work out. It's a very actively managed sort of thing, but if it is done in a sensible and in a fixed periodic manner, then a lot of good can come out to keep you back on track always.
Gaurav, just one quick 10 seconds, Gaurav. The data And right here, right, I'm talking from a global investor's perspective with the net USD, 3-year CAGR, 5-year CAGR, 10-year CAGR, MSCI India has hardly been anything, right? So in that sense, maybe you got to question long only at some point of time. Maybe there is BAF might be an answer for a mutual fund investor. I don't know.
In 2017, we came out with our first asset allocation model. We included a 13% international exposure. This is 2017, right? Indian markets are doing fantastic, and we did not have any small cap. We still don't have. We have pretty much the same model that we have continued with. So we come up with our first asset allocation, this much in debt, this much in index ETFs, and so on and so forth. And we had a 13% international exposure. The two biggest questions we got asked was, why should I invest in international markets? Indian markets are doing fantastically well. Why should I invest in, why don't you have small caps here? Small caps are doing fantastically well. So I think what happens is right now, a lot of the questions that come are around gold and international investing, precisely because these funds have done really well. But at least see what I have seen, and I mean, I've been doing this for 18, 19 years, which is not a long time, by the way, in investing framework. It's a very small sample I've seen live, but I've seen a lot of data. Reversion to mean in larger asset classes usually happens in 3 to 5 time frame, 3 to 5 year time frame. So I would say a better option is just to say that, okay, I want to look at uncorrelated avenues for risk. I have Indian risk, I have international risk, I have debt, I have gold. Think about my asset allocation and then stick through it regardless of which asset class is doing better. Just because gold is doing better, you increase your allocation to 40, you're defeating the entire purpose of doing asset allocation. That's how I would think about this.
Agree, totally.
Actually, either of you have a view on gold? I have one, but either of you have a view on gold? Since we are on it, just very quickly.
I think Gaurav did a very long show yesterday on gold. He is the expert.
Is that so?
I'm not the expert. The basic point was this, that the gold that you bought in the last 4 years was for these 3 months. That is not the same thing as saying that if you have 100 rupees more to invest, you should invest in gold today just because it has done well. So again, going back to the asset allocation, if your asset allocation is 15% gold, stick to that and keep rebalancing. When gold does great, you actually sell gold to buy equity and buy debt. When equity and debt does really well and gold is underperforming, you actually sell equity and debt to buy. Asset allocation rebalancing is a reversion to mean trade. You take money off the table from any asset that has done really well and you put it into an asset that has not done it. So that's my view on it. But Niraj, you tell me.
Let Niraj finish. I'll give my view on this.
Yeah. Okay. No. So, I don't know who is an expert enough to tell what gold would do, but just a couple of things from an Indian investor's perspective, that if indeed we are in the situation that we are in, and if the view that some informed investors can take that maybe the currency depreciates and maybe gold prices are set too high if indeed inflation takes it way back, then yes, don't increase your asset allocation by any means possible, because you are right on that front. But keeping your exposure to gold might also serve as a hedge against both inflation and the rupee depreciation if we were to see that. Imponderables, but you maybe budget for that.
Fair enough.
So I'll take a minute. And look at it from the principles of investing of the great Indian investor for the commodity called gold. Right. Across the country, we have a defined SIP date for gold. It is called Dhanteras or Akshay Tritiya everywhere. Right. And please understand, it's a commodity. So based on demand and supply, the price of gold would be the highest on that day. Right. But you just go and buy, and then you buy and hold it. Right. And you're not just holding that SIP date for one generation, you've been running that SIP date from generation to generation, right? And if that principle of investing is put in any asset class, and a good asset class, you're bound to be more successful than anything else. So from a investing process, there is no better investing process for the Indian that from a learning perspective from gold. I don't have, it's an SIP over generations, right? And if you are a person who tracks prices, just try go and selling gold on Dhanteras. Go to that shop and say, I'm going to sell gold. See how you'll be treated in that shop at that moment of time.
Right.
But those principles don't come into the financial assets. The day they come into financial assets, I think people will be better investors, is my perspective.
It's a very good point. And gold is the ultimate emergency fund.
Correct.
And only resort for really bad emergencies, not like minor emergencies.
Gaurav, that is the beauty of the financial planner of those times. He's added a superstition that this is the last resort. अरे तेरे ये दिन आ गए तू सोना बेच रहा है, you can't
I
sell
know
gold.
you can't sell.
No.
Yeah.
If you are where I come from, trust me, if I am selling gold, means everything is lost.
Right.
That's how we will be treated in the society. And you add that to any good asset, you're going to make some good money. When you look at gold holding, it's probably 4 or 5 generations in any family.
Great, guys. I think it was an amazing conversation. I think we covered a lot of ground as well, from what's happening recently to how an investor handle some of these volatility by asset allocation, by gold planning, and then a very good chat on gold. Just a quick question right before we close. Do you guys personally invest in gold? Like invest in gold, not like buy it for jewelry or something, but you guys,
Sovereign gold bonds.
yeah, gold bonds. So that's actually probably the best way to buy gold. You get 2.5% interest, and if you're not a seller, then that kicker is really strong.
I'm sorry to say this, but we come from the eastern part of the country, whereas guys, we can give Bapida a run for the gold, the amount of gold we carry. On social pressure, we have to buy a fair amount of gold. So there is fair amount of jewelry which
Right.
has to be bought. If I don't buy, then my mom will buy it for me or probably run me down within my family. So that's my status. But yes, my wife doesn't buy gold like I heard you yesterday. So I have to force her to buy some, but she started buying financial gold, which is a good part.
Perfect. Thanks,
But not
guys.
more than 10% of the portfolio. We will not cross 10% of the portfolio.
So that's your asset allocation for gold.
Yes,
That's
yes,
perfect.
10 for gold. Yeah.
Thank you, guys. Thank you. That's very interesting chat. Very helpful. So, guys, there's another episode for Kuvera Insights, and we just spoke to Swarup, who is the MD and CEO of Mirae Asset Management, and Niraj, who is the market editor at Bloomberg Quint. Thanks, guys.